Well, now it is my turn to get to share what I see happening with the Wichita housing forecast. So, excuse me, wow, what a great crowd. I'd been facing the other way. I hadn't really had a chance to see all of you here. So thank you so much for coming out. You all have copies of this year's Wichita housing forecast at your desk. We have lots of copies of those at the realtor's office. I know that they would love for you to come and take boxes and boxes of them away from you, but don't go today. The office is closed because all of the staff is here today. Go over first thing tomorrow morning and pick up boxes. I did want to just mention also that we have copies of our forecasts for the other large markets. If you're interested about Kansas City or Lawrence or Manhattan or Topeka, they're on the back table here just to my left, right by the exit door there. So feel free to take those as well. And all of that is possible. These beautiful publications would not happen if it wasn't for the really, really generous and continuous ongoing support that we have from Security First Title and Meritrust Home Loans. Please join me in giving them a thank you for all the ways that they support the industry. Also need to give an additional thanks to Jessica Miller, one of my former students, and Security First for taking care of the refreshments that we had here today. So we're very, very grateful for that as well. I never want to be remiss in thanking all of you for the partnership that we have. We began this contract with the Kansas Association of Realtors, I think in 2009, something like that, where we not only access the South Central Kansas MLS, but all of the MLS boards across the state, which allows us to put together the monthly statistics that we do and also gives us access to the data for this forecast. And so we're really, really grateful for that partnership that we have. Well, Dr. Yoon talked a little bit about the national economy, and he actually showed this same chart in a slightly different way. It's talking about, he said, those payroll jobs, people who get a paycheck at a business. And I've done this where I show a line and I'm showing it relative to the start of 2020. So what happened with total employment, people at businesses? And by the way, anywhere on these graphs, if you see those little shaded bars, that vertical bar, those are the official dates of recession by that closed little circle, the Recession Dating Committee, with the National Bureau of Economic Research. Excuse me. And so you can see every number on here is the jobs numbers compared to where we were at the start of 2020. And Wichita, we lost about 13.5% of our jobs, over 14% of our jobs between the start of 2020 and July of 2021, and all of that was that 2020. All of that was that pandemic shutdown. And then we've slowly recovered, but right now we're still sitting at about 2.5% lower in our total employment numbers now in Wichita than we were prior to the start of the pandemic. Nationwide, of course, you can see, as Dr. Yoon mentioned, we are above where we were at the start of the pandemic. But that bleak picture that we have for the local housing market stands in real contrast to what we have for the unemployment rate, which looks at households, it looks at people, and it asks, do you have a job? Are you looking for a job? And the unemployment rate in Wichita and in Kansas are at historic lows. And so these two things seem inconsistent with one another. I think there are several reasons why we see this difference. The first reason is, I've been talking with industry groups for almost 25 years now, and one of the consistent themes we've had all over that time is the worried about all the gray hair in the room. And we need to get your students out because we need people to be in property managers. We need to get people who are going to be appraisers. We need to get people who are going to be realtors. Because look at all of us, we're going to retire, and then who's going to take our place? Okay? We've been talking about this for a long time, the retirement of the baby boomers, right? Well, one of the things that I believe happened during the pandemic is that there were people who maybe were going to retire in 2, 3, 4 years, but you know what? I don't need to deal with all this stuff. Let's just go ahead and retire now. And so we saw people leave the labor force. And Dr. Yoon said, you know, people who are in their basements playing video games, they're not in the unemployed numbers, right? They're not counted as unemployed. I don't know how many of the old baby boomers are in their basement playing video games, but if you retire, you're out of the labor force too. And so that's one factor. And the other factor is that over the last 2 years, we have seen wages, especially at some of the lowest level jobs, just skyrocket. Remember when everybody was pushing for a $15 an hour minimum wage, and that was kind of the big talk? Drive through any drive-through in town, and you'll see where they're hiring it up to $20 an hour. You know, they want adults, you know, but even teenagers, they're hiring at very high wage rates. So for those who were at the lowest levels of the income spectrum, 3, 4 years ago, you may have had to have 2 jobs to be able to make ends meet. That was for 2 reasons. Number one was because of the very low pay. You're only making $10 an hour or $12 an hour. And number two, they wouldn't let you work more than 30 hours because they didn't want to have to pay benefits. Well, now everybody's struggling so much that they're willing to say, we'll pay you $18 an hour, we'll pay you $20 an hour to work and clean the hotel and so forth. And we'll give you the full-time time so that you end up getting benefits as well. As a result, I think that there is at least a significant number of people who used to work 2 or more jobs that now only need to work 1 job. That meant that on these employment numbers, they were showing up twice, 2 paychecks. But on the unemployment number, they were only showing up once. And so now that could be a second reason why we're seeing this dichotomy between what we see from the employers and the jobs numbers versus what we're seeing from the unemployment side of things. You look at this, and the labor market does not say we're in a recession. And I respect Dr. Yoon and his desire to have a very definitive, concrete measure of a recession. The Recession Dating Committee treats it a little bit more like the Supreme Court treats pornography, right? We know it when we see it. And I think that there's some element to that makes some sense, because the formal definition they have for a recession is a decline in economic activity that is widespread and lasts for more than a few months. So it's a very fuzzy definition. And then they just go and look at it and they try and make a call. One of the things they look at is GDP growth, that negative GDP growth. How negative makes a difference? And what's happening with employment? What's happening with payrolls and incomes? And they look at all of those things together. And I think there's value in that. So what is the economic forecast going forward? These are the numbers that Jeremy Hill with the Center for Economic Development and Business Research released a couple of weeks ago. 2022 is almost in the books, and no matter what happens going forwards, he thinks we'll end the year up about 2.7%. This number is not in your booklets, by the way. I released our booklet one day before he did his. I didn't want to get buried under the media coverage that he had. So I couldn't release these numbers quite yet. But the forecast for 2023 and 2024, he actually carries it out 2 years. This is his optimistic forecast. He also has a pessimistic forecast. His pessimistic look, both of us were facing real struggles with this year because, I had to go to press basically the first week of September with my booklets. And so by the time I had those things, mortgage rates had gone from 6.5% back down to 6%, and were appearing to head back down at that point in time. And now we're up to 7%. So there's a lot of change. And when the economy is just going smooth and easy, it's easy to predict. When weirdness is happening, it's anybody's guess, okay? So Jeremy's negative forecast, his pessimistic forecast, is essentially for employment growth in Wichita to be flat next year, okay? Not a decline in employment. And if we have that flat, his forecast for 2024 is much stronger growth, where we almost recover back to the level that he has here. So that employment forecast is actually a pretty strong employment forecast either way that you go. I will note that he has said that the aviation industry is incredibly strong right now, both commercial aviation and general aviation. Now, if we end up with a severe economic recession in the United States, we all know in Wichita that we tend to be about 6 months to 9 months lagged from that. And a lot of that has to do with our aviation industry because businesses don't buy jets and businesses don't send their people traveling as much. And that then affects both general aviation and commercial aviation. So, you know, two-armed economist, right, was the bane of President Truman's existence. You know, give me a one-armed economist on the one hand, on the other hand. This is certainly a two-hand situation that we're in right now. The other piece that we want to think about is what's happening with mortgage rates. And Dr. Yoon talked about the high inflation environment. And I didn't include a lot of slides because I thought he would talk about this perhaps more than he did. But what really matters for mortgage rates isn't where inflation is right now. What matters for mortgage rates is where investors believe it will be over the next 5-10 years, which is the typical holding period for a 30-year fixed rate mortgage. Okay? Most 30-year fixed rate mortgages are paid back within 5 to 10 years. The headline CPI number at the top there, you know, very high, 8.2% last month, very high inflation. The middle line there is a survey done by the University of Michigan that surveys households. And they ask, what do you think inflation will be over the coming year? And households right now are saying, oh, maybe 5%. That's about the range where it is. But the orange line at the bottom is a measure that is based on financial markets. And so with a traditional Treasury security, if you wanted to go buy a 5-year Treasury note, you could do that, and what you would do is you might buy it, and it would have a $1,000 par value. That means it's the amount that they owe you, $1,000 face value bond. And every 6 months, they'd pay you the interest rate that was promised on that, based on that $1,000 face value. At the end of 5 years, you would then receive all of the principal back. You'd receive the $1,000 par value. That's a traditional Treasury security. And when you buy that as an investor, you have to be worried about inflation because every dollar you get paid back in the future will be eroded by the inflation that actually occurs. That means that the interest rate on that 5-year Treasury security has to be higher to compensate for it. There's another Treasury security that's called a TIPS security, TIPS, for Treasury Inflation Protected Security. And what happens is that $1,000 par value bond, at the end of the year, they increase the face value of the principal, the amount that the government will pay you back. And so if it's been 8% inflation, they'll add $80 to that bond. It's now no longer a $1,000 bond, it's a $1,080 bond. The interest that you get the next year is going to be calculated based on that $1,080 principal amount. And then at the end, you're going to get that $1,080 back. But it doesn't just happen once. It happens every single year over those 5 years. As a result, with that bond, you're protected on the back end for actual inflation that occurs. Does that make sense? Since you're protected on the back end, whenever inflation happens, you're going to get more money. You don't have to build that into the interest rate on the front end. And so the difference in interest rates between a traditional Treasury security and this TIPS security, we call that the 5-year break-even rate. And it is a measure of what financial markets believe the average inflation rate will be over the next 5 years. And I liken it to the Vegas line, right? I think the line for the Chiefs game last weekend was a 2.5 point line, right? The Vegas, what they're not trying to be smart or funny or anything. All they're trying to do is equalize the money that bet for the Chiefs and the money that bet against the Chiefs. And they adjust the line to reflect, in essence, the price that the market says it should be. Same thing's happening in financial markets. Investors are putting in literally hundreds of billions of dollars in these treasury securities. And they're not doing it on a whim. They're making bets on what they think inflation will be. And so you can see that 5-year break-even rate right now is about 2.5%. That means that investors who are putting, again, literally hundreds of billions of dollars on the line in this are saying, on average, we think average inflation over the next 5 years will be 2.5%. That's what I look at to believe that interest rates, mortgage rates, will actually be coming down sooner than what Dr. Yoon was suggesting. Now, one of us will be right, or neither of us will be right. So that's just the way that it goes. But I will say that the Mortgage Bankers Association is still making the same bet. They're, from what was in your booklet, they had been forecasting a 4.8% in 30-year fixed mortgage rate by the end of next year. They have since revised that up. They now forecast it to be 5% by the end of next year. I keep looking back daily to see when they'll revise this. I am sure that they will revise that up, but I am also certain that they will revise it, that it will at least be underneath that 6% rate. I will be personally surprised if interest rates continue to rise from where we are. I won't be shocked, but if they do go up, I think it will be a relatively short-term phenomenon that they go up, okay? And that they will be coming back down over the coming months and years, okay? So what's been happening with home sales? You know the broad thing. One of the things that I wanted to do with this year's forecast, though, was to try and give a broader, long-term perspective of what's been happening. Because this last 2 years has been so unusual that it becomes very, very difficult to have perspective. And so I went back to 2001 with your South Central Kansas MLS listings here. And yes, there have been some changes that happened over time. We expanded to include Arc City and Wellington. Those don't shift the numbers very much. That doesn't make a big difference here. And so what you can see is that through the early 2000s, we were averaging, early about 750 homes a month, went up to about 1,000 homes a month by 2007, 2006 and 7. Then we had the financial crisis. And you'll notice I always refer to it as the financial crisis. It wasn't a housing crisis per se. It was a financial crisis, a debt crisis that was triggered, but not caused by things that happened in housing markets. It was triggered. There were lots of more fundamental things. If you ever want me to share with you all of that, actually there's a great book called Slapped by the Invisible Hand that talks about the financial crisis and the real issues there. But we can share with more of that later. We saw some sharp home declines. You gotta love that little blip that we see there in 2010. That was the tax credits. Remember that blip? And then they kept going down. We bottomed out in 2011, and then we started going up. And we kept going up and up and up and up. And by the time we hit 2019, we'd really kind of flatlined. We'd gotten to a place where we weren't selling any more homes. Why? Because there was nothing on the market to sell, right? It wasn't for a lack of demand. It was because there was a lack of quality inventory. Then the pandemic hit, and sales took off again. And this is my thought process of what happened. If you'll recall our forecast in 2020, when we were forecasting 2021, we thought home sales activity would decline and we'd have slightly reduced demand, and because we thought that the pandemic was going to impact employment more than it did. But it turned out, as I look at things, I think there are 5 things that instead of demand softening during the pandemic, the demand just absolutely exploded. And so what were the 5 factors? Well, number 1, it turned out that the home buying population, people who are more likely to buy, were the least likely to be laid off, right? Most of us could pivot and work from home. We did not have to be in a position. It was the people who were more likely to be renters that ended up losing jobs. You're waiting tables. Allison, did you lose your job waiting tables for a while? Yeah, yeah. And I'm guessing you're not a homeowner right now. No. So one of my students. I give some great couple students here. Do I have other students here in the room? So yeah. Remind me your name. I'm sorry. Alec. So I've got Allison, Christian, and Alec here, and I just want to call you Jeff. It's Nathan, right? Nathan DeGraffenried here. And so we got some students here with us today. Those are the people who are most likely to be laid off, but they're also most likely to be renters, right? Home buyers didn't end up losing that as much. Moreover, we all got the stimulus checks, whether we lost our jobs or not. 2, sometimes 3 rounds of stimulus. So as a result, we also couldn't go out and spend that money. We couldn't go out to restaurants. We couldn't go out and travel. We couldn't buy some things because of supply chain issues. So households got their financial situation in the best shape it had been in decades. Number 4, people were sitting around looking at their own 4 walls. And while I don't think it was as much, oh, I need a home office, I think it was more cabin fever. I'm just sick of these 4 walls. I want something different. And then number 5, the Fed moved aggressively to drive down mortgage rates by buying mortgage-backed securities. And those 3%, even sub 3% mortgage rates, I think there were a lot of households that said, this will never happen again. I'm going to go buy. And so when Dr. Yoon showed that where people were saying it's a bad time to buy, right? In 2021, they were saying it's a bad time to buy. They were still buying, right? It may be a bad time to buy, but they didn't want to miss out if they could get in on it. And so what is our forecast? Our forecast, I actually think, given the numbers that we've seen since we came down, I think we'll end up even lower this year. Year to date, I don't remember the year to date numbers right now, but it's significantly below this. So we'll see a significant decline in home sales activity. Our forecast for 2023 is essentially flat, not further declines next year. And the reason for that isn't because of declining demand, although absolutely demand is much softer than it was 6 months or a year ago. The reason is the lack of inventory. And again, I thought some historic perspective. This is the number of active listings on the South Central Kansas MLS. And you can see through the early 2000s, we kept adding more and more homes. We really didn't see what seemed like a bubble in that sense. But when the housing market collapsed, because essentially mortgage finance shut down in 2008 and 2009, we saw a slight increase in active listings because sales had slowed down so much. And then it just took us a long time to work down that inventory. And by the time we hit 2014, 2015, we were probably in a pretty good place. 3,000 active listings, that was probably a good place for us. But we just kept whittling them down. We did not add new homes at the pace that we were selling them. You guys were just doing your jobs too well. And so we'd gotten to the place where at the beginning of 2020, we were at about 2,000 homes available on the market. That's just far too few. And we talked about strong home price appreciation, flat sales. All of this was due to a lack of inventory. Then essentially people started buying up the crap that was left, right? And anything that was new being put on, that's where you saw these incredible bidding wars when people could put something that was on the market. Dr. Yoon talked a little bit about this. I'm presenting it in a slightly different way. It's what percentage of homes were selling at a discount compared to their original asking price. So this is the original list price, not the list price at the time of the contract. And again, go back to 2000. We were looking at about 60% of homes would sell below their original asking price. That's normal, the normal negotiation process, right? Oh, they're asking 150, we'll bid 140. We negotiate, we settle at 145. That's a discount compared to the original asking price. That means that 40% of homes sold at or above the original list price. As we came out of the financial crisis, that went up to where 80% of the homes were selling at a discount. Hey, it was a buyer's market back then, and so buyers could negotiate more. That came back down, and we were back to about 60% prior to the onset of the pandemic. Most recent numbers, yes, it's starting to turn back up. We're seeing things be more, but we're still at a place where we're less than 40% of all homes that are sold in the most recent months have been selling at a discount compared to their original asking price. And that's really, really low. And my point with all of this is that, oh, here's another way of looking at it. Median days on market. Again, long-term perspective. Back in the early 2000s, it was taking 40 days on average. Half the homes would sell in more than 40 days, half would sell in less than 40 days. The buyer's market back in the 2010, 11, days on market went way up. It took a lot longer to sell. As we've come back down, we were down to below 20 days on market before the pandemic. And since then, now we're down to about a week is the median days on market, 6 days, 7 days, something like that. And it was, I think at the lowest point, 1 or 2 days. I mean, it was just absolutely insane. By the way, I saw some of you taking pictures. Awesome, great. Post them, do everything. But if you want my PowerPoint slides, they're posted on the center's website. Go to wichita.edu/real estate, and it'll be the top thing that's on there right now, and it should stay on there for the next few days. But if you go into research and presentations, it'll be there forever. Okay, so those are available. We are also recording today, and so when that's available, we'll make that video available too. So the way that, as an economist, as Dr. Yoon said, we like this hard and fast measure, something that's a really clear, easy way to define it. And the statistical framework that we have for a seller's market is this month's supply figure. Take the number of active listings, divide it by the average pace of sales over the prior year. So if there are 1,000 homes on the market, you're selling 200 homes a month. 1,000 divided by 200, a 5-month supply. We typically think of a balanced market as having between a 4 and a 6-month supply. When you get up above, like we were back in 2010 and 2011, Wichita, we went up to almost an 8-month supply. That's consistent with what we think of as a buyer's market. Lots of negotiating power for the buyers. When you get below a 4-month supply, that's more consistent with a seller's market. Now, I should say, as economists, we like these numbers to have a threshold. It turns out people don't always behave the way our economic models say they should. And so sometimes, I think even as we got to a place where we were technically in a seller's market in 2014 and 2015 and even 2016, it was probably a pretty balanced market back then in terms of that. But certainly by the time we got to 2018 and 19, it was a clear seller's market, and that's what you all told me. Well, again, it went down even lower. We got down, I think the lowest we had with month supply was like a 0.4 month supply was the lowest point that we hit. And even now, we're still sitting at just barely over a 1-month supply. And some of this uptick, you'll notice there's seasonality here because of the way it's measured. This time of year is always a little bit higher compared to others. What's my takeaway from all of that? Even if demand drops off dramatically, we just won't see, much like Lawrence Yoon said, we should not see price depreciation, price declines in the Wichita market. There just isn't enough inventory. And again, I wanted to give some long-term perspective here. So again, Wichita is that yellow line, goes all the way back to 1980 of year-over-year home price appreciation in the Wichita market, Kansas, and the US as a whole. And one of the things that I wanted to highlight with this was that you go back to 2008, 9, 10, 11, when we had the depths of the financial crisis, and the US, first of all, in the boom in the early 2000s, you saw that great price increase nationwide. We didn't see that. We just kept bouncing around. Good, healthy appreciation, 4 to 5%. That was typical for us, but nothing that was spectacular. When the financial crisis hit and the mortgage spigot closed off, we just dropped down to essentially bounce around zero. Home prices in Wichita did not decline measurably. We'd have one quarter where it was negative, maybe a little bit negative, then one slightly positive. We had a 5 or 6 year period where it just bounced around zero, okay? Now, even with low inflation, that's real price declines, right? Inflation adjusted, it's down. But my point here is that even in a place where you could argue we had a very clear buyer's market, and where there were lots of fundamental problems and lots of excess inventory, we didn't see significant price declines in Wichita. Contrast that with now, again, we were bouncing around prior to the pandemic with, that really solid 4 or 5% price appreciation. That's really strong appreciation for Wichita. But then when that demand got juiced up, it happened in an environment where there was no inventory, and that's why we've seen home prices. Through the first half of this year, average home values in Wichita, same home is the way this is measured, increased over 17% compared to the prior year. I mean, that's just absolutely stunning, inconceivable home price appreciation. It's not sustainable. Home price appreciation will slow. But slowing home price appreciation doesn't mean falling home prices. Our forecast for this year is that we will end the year up 12.9%. That's a lot less than the 17% we said. Home price appreciation is slowing, but so much of that's already baked into the system, we can't make it up without severe price declines. Severe price declines can't happen if there's a shortage of inventory relative to even lessened demand. And so our forecast for next year is to go back to good normal, right, for home price appreciation. 4.7%, that's really strong for Wichita, and that reflects that tight inventories that we had. So, how do we resolve these inventory issues? Well, there are a lot of different pieces to it, but one of them is building new homes. And so, again, long-term perspective, going back to 95 of single-family building permits in the Wichita area. And you can see that we were building, on average, there'd be these little cycles that we would have, but on average, 200 homes a month there, plus or minus, for the 90s, the 2000s, up until the financial crisis. And then it collapsed, and we dropped down to a level where it was only about 60 homes a month. We've since gotten back up, and we were averaging what ultimately translated into about 1,000 new building permits a year. For a number of years. And that just wasn't enough to meet the demand that we had. But price issues, through a lot of these years, 2014, 15, 16, those were times when we had come out of the flat existing home prices, but construction costs had kept going up. And so you remember me talking how the value proposition of an existing home versus a new home was really difficult back in 2015 and 16. It had to be somebody who just wanted what they wanted, and they had the money because they could get more for their money by buying an existing home, okay? Well, that steadily worked its way down, and we were starting to get to a place where existing home prices were appreciating, that it was starting to bring more balance between the two segments. And then the last 2 years happened. Construction costs went up extremely high as well. And so it's really difficult here. Our forecast, oh, by the way, what about apartments? So this is total building permits. This includes multifamily, it includes single family, it includes duplexes. Again, we were averaging maybe 200 units a month back in that era. Maybe we're just back there, but we've been well below what we've needed for housing for a long time. There's one more factor. that I think is one. And I've asked this question a lot because I kept expecting in the multifamily side. I mean, we've been building a lot of apartments, right? And a lot of nice apartments. And here's what apartment developers do. Do I have any apartment developers in the room here today? Well, they'll back me up on this. Apartment developers build as long as the bankers will give them money, right? And so let's just say everybody looks, we're under apartmented in the market. We need 2,000 new units of apartments in the Wichita area, okay? And so we end up with 6 different developers who are each going to build 500 unit complex. And so we've got 6 developers building a 500 unit complex. We're adding 3,000 units to the market. Everybody's convinced theirs is going to be successful. We only had demand for 2,000 new units, so we overbuilt. And this is a long-term cycle in Wichita, right? It's a long-term cycle everywhere. You overbuild the apartments, you stop building, absorption clears that out eventually. Kept wondering when it was going to happen here with all the apartment building. And every new apartment project that comes open, highest rates we've ever seen, they fill up right away, it's been tremendous. I thought, well, maybe it's changing preferences. Maybe what's happening is that people, what used to be Class A apartments are now maybe Class B plus, B, and people are going to move from them to the apartments that have the nicest bling. But you talk to property managers and they say Class B apartments, they have the highest, strong rent growth, high occupancy rates. Well, maybe it's the crap apartments, the Class C and the Class D. Nope, they're doing great as well. How did we not overbuild apartments? Especially as we've been seeing people wanting to move to be owner occupied. Well, one thing that's been a very long-term secular trend has been a decrease in the average household size. How many people live in a housing unit, okay? And back in the year 2000, these are US figures that we had this average. The average number of people per household was 2.62. 2021, the latest figures we have, it was 2.51. Now that might not sound like much, but let me get my cheat sheet here because I wrote down this number. Where did I put these things? Here we go. So if we go to the Wichita MSA population, last year our population in the Wichita metropolitan area was roughly 650,000, okay? Based on 2.51 people per household, that means we need 258,000 housing units for everybody who lives here to live in a household, okay? Based on that 2.62 number we had back in 2000, we need 247,000 housing units. The difference is almost 11,000 housing units, which means that compared to 2000 to today, in addition to the new housing that we need for population growth, which yes, we do still have population growth, in addition to the new housing we need to replace the old stock that is either just totally worn out or doesn't meet the needs and desires that people have today, we needed an extra 11,000 new housing units to account for the fact that there are fewer people living in each of them. And so I think that's another factor that has led to that stronger demand that we've had. And so when I sent this number to Pat Goebel over at Star Lumber. Patrick, are you here today? I thought he was going to come by here today. He asked me for it the day before. I said, sure, I'll send it to you. I sent him the numbers, and he just emailed me back, and he goes, boy, I hope you're right. And our forecast is basically that we've settled into a new normal in new home construction. We've been bouncing around 1,000 permits per year for a long time, and we've kind of jumped up where I think we're now up at about 1,500 permits per year. Remember that when I went to press with this, mortgage rates had come back down just slightly. And so if mortgage rates do stay higher, they're clearly having an impact on potential new home buyers. But I believe that the impact that the increasing mortgage rates has is one of getting acclimated, right? It's a shock when you first put your foot in that swimming pool in the summer, right? Oh, wow, that water's cold. But you get in, you get used to it, and all of a sudden, it feels pretty good, right? Well, 7% mortgage rates won't feel good, but certainly a lot better than 13% or 18%, right? The point is, I think that there is this shock effect that buyers have, where they'll say, oh my goodness, the rates were 3% 6 months ago and now they're 7%, I will never buy again. But people are driven by life needs. People love their 3% rate more than their children. I liked that line that Dr. Yoon had. Eventually those kids are going to drive them nuts and they're going to need to get a bigger house. Most real estate transactions should take place because of changing life circumstances. I got married, I got divorced, we had children, children moved out, I have a new job, whatever that life circumstance is, and people adapt to the interest rate environment that we're in with that. Believe it or not, people still bought and sold homes in the early 1980s, and they did it when they were giving up their 5% mortgage rates that they had from the late 60s and early 70s in order to deal with the life situations that they had. And so when it comes to new home construction, could we see a blip coming because of that? Yes, but I do think this 1,500 permits per year is kind of where we're settling out again right now. And so I will be very interested to hear what Jeff says. And I told Jeff earlier, Jeff Mullen with Ritchie Development, I said, please tell me I'm wrong. People do it all the time. And that's a part of the conversation that we want to have. And so that's our overall forecast. Again, I want to really thank Security First and Meritrust. And I took too much of my time.